My
Okay.
Jones. That
All
was a
right.
process.
I was trying to log on my computer, was not working. So now you've got me on my phone.
You know what's funny is my computer wasn't working either, and I probably should have told you that before we started because I tried to
Yes.
do it through and it wouldn't let me do it. Okay, so for those of you who don't know us, if this gets shared to somebody else, my name is Zack Sperow. I'm a top producing realtor in Napa Valley and Solano County, and I'm also expanding into Sonoma County. So that's something new for me. And I'm here with Cross Country Mortgage, top 1% lender in the nation, a good friend of mine, and also just a market expert when it comes to mortgages and mortgage rates. As some of you may know, inflation is on the rise. You know, like Oreos are like $5 now. Avocados are like $5 too. Like I really have choices I have to make. And I get like 18 Oreos or I get one avocado. You have an option. And so also what that comes is the government trying to control inflation and keep it, tampered down so people can still afford their life and things don't just get out of hand super fast. So with that, they're trying to increase the mortgage rates and have been increasing the mortgage rates. And so now we are here today with Monica to talk about it. And I have a few questions for you, Monica, and we'll kind of go through them and people can chime in if they have questions. They can definitely, ask in here.
Awesome. Okay.
Cool.
Love it.
So what are rates today and where were rates at back in December or January just pre?
Yeah, so a couple of things. With rates are definitely on the rise, right? We are in a rising interest rate environment. We have been for the last 12 months or so. Rates actually dipped to their all-time lows January of 2021. So they've been slowly increasing since then. But what we've seen year to date is more of a exponential speed in how quickly interest rates are rising. So I think that's probably the biggest shock for people is that rates didn't rise very slowly this year. They kind of just shot off like a roller coaster. So it left people, I think, a little bit startled as far as, oh my gosh, how did rates move so quickly? They were in, the high 2s and low 3s. Now we're in the high 4s, low 5s, depending on the type of loan that the client's looking for. But the thing to keep in mind, even in today's market, you can have any interest rate you want, right? Like if you said, Monica, I want a 3% 30-year fixed mortgage, you can have it, it's available, I've got it. But the thing to keep in mind is the further below market that you want the interest rate to be, the more you would pay upfront to actually get that interest rate. So sometimes it makes sense to pay points to buy down the rate. In other times it doesn't. Mortgages are not a one-size-fits-all deal. So it's definitely something worth exploring with your loan officer, hopefully me, so we can talk through the pros and cons of buying down the interest rate and if it actually makes sense for you.
Yeah. So to give everybody an example of why I'm bringing this up too, I bought my home in December 2020 and Monica was actually my lender. My rate is at 2.625%. And at the time, like, you don't understand how good this is. And I was like, I'm paying $77 more than I want to. I don't know if you want to remember that conversation. And I was upset about that $77. And she was like, you need to calm down. Like, this is the best situation you could have been in. And now rates are almost double for the same type of mortgage and conventional mortgage rates. So, I think people are having a lot of issues with this. And back in February, I actually hosted an open house in Vallejo, California, and I had over 30 groups through. The guy who got his offer accepted did pay quite a bit over asking, but he also had mentioned to me at the open house that he was previously pre-approved for like $650,000, and then his pre-approval had dropped to $575 within a matter of like 2.5 months. So purchasing power is down. Rates have been increasing, but have they been increasing on speculation, or has the government already started this process of increasing rates? Because I've been hearing both sides of the coin.
Yeah, good question. So I think what's important is to put in perspective the rates that we've seen over the last couple of years, like in the 2s and the 3s, like that is not real life. That is not normal. Okay, so that is what we call artificially low interest rates. Okay, so in March of 2020, our federal government stepped in at the start of COVID, right? We saw when COVID hit, the country shut down, stock market started going crazy, interest rates went up to 5% overnight. Like all of the markets were very unsettled. So our Fed stepped in and started buying $120 billion a month of mortgage-backed securities. They did that to bring interest rates down. They did that to spur the economy, to make sure housing stayed good, right? They wanted people to spend money. They wanted the economy to keep moving. And so they brought interest rates down where, you know, it was a no-brainer, right? To be able to take out a loan, to borrow money, to spend money. And it worked. And it might have worked a little bit too well because now we have an inflation issue, right? The Fed did not taper back their purchases quickly enough. They thought our inflation problem was transitory. It is not, which is why now we've got this, you know, 40-year high on inflation. So the Fed is now taking steps. They have not only tapered, but completed their purchases of mortgage-backed securities, which means the bond market is now standing on its own 2 feet. This is actually normal, real life, right? And so if we think about where were interest rates right before the Fed stepped in March of 2020, well, guess what? Rates were at the high 4s and low 5s. Like we were here right before the pandemic hit, but how quickly we forget because we've just been so accustomed these last couple of years to super artificially low interest rates, right? We've kind of gotten spoiled. And for the people that did take action, like you over the last couple of years and bought homes and locked in their rates for 30 years, you've got something we may never see again in our lifetime. I mean, who knows, right? But what we're seeing today is actually normal. So if we go back the last 50, 60, 70 years and look at interest rates, the average interest rate going back the last 50 plus years is over 7%. Okay, so that takes into account the highs, the lows, everything. The average interest rate is 7%. So even the rates we're seeing today in the high 4s, the low 5s are still below average. And I know it's hard to kind of accept that because we've, again, the last few years been very accustomed to really low rates that are artificially low. But this is actually still a really great opportunity for interest rates, right? To be able to lock in something in the high 4s, in the low 5s. If rates continue to climb and go to 6 or 7, which is actually the average interest rate, you're going to be doing the happy dance that you've got a rate in the high 4s, right? Mm-hmm. So the thing to remember with rates is they really don't matter, okay? Don't ever try to time the market with interest rates. It's a terrible idea, okay? What matters is payment. Can you afford the house? If you can afford the house, you can afford the payment. That is what matters. Now, if you lock in today, let's say a rate in the high 4s, you lock in, you can afford the payment, and rates, again, continue to rise to 5, 6, 7, well, guess what? You'll be, again, doing that happy dance that you've got a rate that's no longer available. Now, let's say you lock in today in the high 4s and rates come down in a year or two, right? Then you can always take advantage of those lower rates should they become available. So you're protected on both sides of the coin, right? So the best thing you can do is just make sure you're comfortable with the payment, get into the home, and then if rates come down, you can take advantage of it. If they go up, you'll be doing the happy dance. So either way, you could do a happy dance, right? If rates come down, you save money, you do the happy dance. Rates go up, you're like, woohoo, I have a rate that's not available anymore. So yeah, rates really don't matter. Payment matters, affordability matters.
Yeah, I actually remember you helped some of our clients, Kim and Brandon, and they bought a home, I think in 2018, late 2018, maybe early 2019. Anyways, their rates were like close to 5%, and they refinanced. And when they refinanced, their rate was at like 3.35 back during the pandemic. And he was like, we're saving like $700 or $600 a month. And they just had a baby. I was like, oh my gosh, that's like childcare, extra funds. So it is a really great statement for you to say that because it really does happen. People, you know, if you live long enough and you stay in your home long enough, it will happen where the rates will adjust and come back down at some point. Maybe not to the historic lows that we saw.
Exactly.
But they will. Okay, so you talked about the bond market standing on its own 2 feet. Is it volatile at the moment, or are people pouring money into it?
No, we're seeing a ton of volatility, a ton. So we're seeing big swings every single day, which is why it's more important than ever to be working with a mortgage professional who's actually watching and tracking the bond market, who understands the technical signals and can really give you advice on a locking strategy once you're in contract. Because you guys would be shocked and appalled at how many loan officers do not watch the bond market, do not track it. They simply will just tell you once you're in contract, sorry, the rate's gone up, because the rates are moving that quickly in both directions. So today the bond market, opened up really well. Yesterday it did really well. We're giving up some of those gains right now, right? Like it's all over the board. But again, the best thing you can do is work with someone who's got their finger on the trigger and is watching the market so they can give you advice, around your locking strategy.
And is there a time in history that we can compare this to? Obviously, I think a lot of people are really freaking out right now because from December, I think rates were like at average like at 3.25 or 3.11 at some point. And now I've seen numbers as high as 5.5, 5.8 with people that don't have maybe the best credit scores. That short of a time to have this much change is kind of drastic. How has the market reacted, and how do you expect it to react in the future with housing prices?
Well, I think what we're seeing in the last couple of years is that, and this is true for the stock market as well, the markets are correcting a lot quicker, right? So they're getting whereas before maybe it would have taken a few months to kind of see this change and for the market to kind of really stabilize and normalize, we're seeing those changes happen faster. So we're not, sometimes it feels like ripping off a Band-Aid, but then at least we get there, right? Like we're there. So we just, again, it can be a little bit startling if you weren't prepared or anticipating it. But again, this is more normal. Like this is where rates really should be. Having rates in the 2s and 3s doesn't happen on its own. That only was a function of our Fed pouring, again, billions of dollars into our bond market to bring those interest rates down. So we have seen rates rise like this in the past. It's been many, many years and decades since they've risen this quickly. But we have seen rates here. They were here just in 2019. So we have been here before. And again, on average interest rate is over 7%. So like what we're seeing is still a great buying opportunity. It's still an opportunity to fix a below average interest rate.
Yeah. And as a listing agent, for those of you watching, what I'm seeing are, before we had maybe 20 to 30 offers on one single home. Now I'm seeing more of like the 2 to 10 offer range. Not everywhere, not every house. It depends on the pricing, right? And depends on the area. But we're seeing a lot less people in the buyer pool. Do you expect that prices will adjust because of these rates as they continue to climb, if you could think they're going to climb?
Yeah, I do think home prices are going to continue to climb. I think we have still a very strong demand. I think we still have very limited inventory and supply. I think I read we are undersupplied 4 million homes across the United States. And California has one of the worst inventory problems of all the states. And so when you have limited supply and you still have strong demand, which we do still have strong demand, that leads to stable and consistent home prices over time. So what I think is going to happen is we're not going to see appreciation, at 18 and 20% every year like we've seen for the last few years, but that's actually a good thing, right? Like 20% appreciation is not sustainable. That also is not normal. That also is a function of really below average interest rates because people could afford more, right? And there was a great opportunity for people to buy. And so I do think we're going to see home prices continue to increase. I do think we're going to see the rate of appreciation slow down, but that's different than home prices coming down. I do not think home prices are going to go in reverse. I don't think they're going to come down. I think they might not go up as fast, but I do think they're going to go up probably 7, 8%, maybe even more than that this year. So again, someone buying a home today has a phenomenal opportunity to build wealth through real estate, right? So people don't have to worry about, oh, I missed my opportunity. You don't have to worry about that. Home prices are still increasing. It's still a phenomenal opportunity to be a homeowner.
Yeah. And I think what you're saying here is there is not a crash coming, which is, I think, everybody prays for, because there were so many people that were of that. Like, think about, let's just say did buy a home in like 2011, 2012, or 2013, kind of after that whole aftermath, and were able to purchase. You've been able to hold on to that home, and now you were able to lower your interest rate to this historic low. Like, there's no reason for you to leave either. And that's what I told Valerie at home, is I was like, we shouldn't leave this house because it's such a good situation for us. Our payment is so affordable. Why would we go anywhere else? You know, we're really in a good situation, which also affects the supply problem, because I'm not going to sell to go move up into a different home, because I'd rather just stay there and enjoy this payment for as long as I can.
And some people may be in that boat too, where they're like, gosh, my payment's so low, my rate's so low. Bought the house, and, I've got so much equity that buying would really increase my payment, right? And then, so there's those people that are going to stay. But then there's people who maybe bought a home and they're going to like physically outgrow that home, right? As their family grows and, things change, or they get relocated, or job changes, whatever it may be. And so this is a great opportunity to turn that really low payment into potentially an investment property, where you have the ability to have positive cash flow, and then can turn around and make your next purchase. So I think we could see it both ways, but I think you're right that it's going to be tough for people to want to give up and make a move when they've got a really great situation, low interest rate, low payment.
It doesn't also that rents are sky high. And if you have, now let's just say you have this buyer pool of people that have been wanting to purchase. If they aren't able to purchase, they're going to have to rent. So rents will probably increase too.
Absolutely.
And for a lot of millennials, the word recession kind of triggers the Great Recession. It goes straight to this idea and thought that it is going to be one of the worst things we've ever seen. Families out on the street, not being able to stay in their homes. It is a constant thought. And it's funny because I always try to remind myself, I'm like, we went through a recession during the beginning of the pandemic, right? We're expected to go into another one here shortly. First of all, when do you think that recession is going to happen? And what do you perceive it to look like? Are we going to see job loss and things like that? Because I'll let you go first, and then I'll say what I think.
So I do think, and I'm glad you brought it up, because sometimes people equate recession with doom and gloom when it comes to housing. And so I'm always like, okay, let's look at the history. Let's look at the facts. Let's look at the data. Let's not just be emotional, like Chicken Little, the sky is falling, type scenario. So if we go back since 1960s, we've had 9 recessions. Okay. So of those 9 recessions, do you know how many of those recessions saw housing decline?
Probably one.
And that was the '08 recession that literally was caused by housing and bad mortgage decisions, right? Like, that was a little bit of an anomaly. That wasn't a normal, market that happened. And so if we, again, going back to the 60s, right? So that's 60 years, all of the 9 recessions, only the one, housing didn't continue to increase. So I know we're going to, I know, crystal ball, it's anticipated we're going to be in a recession probably sometime within the next 12 months. I think we will see things tighten up when it comes to the stock market. I think we'll see some corrections there. But housing typically does very well. Again, 8 out of the last 9 recessions, going back the last 60 years, housing has continued to increase during the recession. And here's the other thing. Stock market typically struggles in a recession. And what does that mean for interest rates? That means interest rates come down. So what I am anticipating is that everyone who's buying a house today may have an opportunity to refinance in the next 12 to 18 months. We may see rates come down, right? And again, they'll have home appreciation, right? They would have paid down some of their mortgage. They have a financial benefit to buying now, and they may be able to lower their payments down the road. Now, what we don't know is how much rates will come down and from what levels they're going to be coming down from, right? Are they going to go up to 6? And then come down to 5? I don't know. But there definitely will be a recession. Rates tend to typically come down during a recession. So it's a great opportunity for people to refinance and potentially lower their current payments. Also a great opportunity for people to be able to purchase.
Yeah, I think that's the biggest thing for millennials, is that they don't understand that recessions don't equal, housing crisis, right?
Correct.
That does not equate. It's not the same thing. And actually, if we look back at what happened during the beginning of the pandemic, definitely did not happen, right?
Right. That's a great example.
Price increases like crazy. I think that what you just said about the reprieve, there's a lot of people speculating that reprieve for interest rates during the recession period. Um, like you said, you don't know if it, like, let's just say rates go up to 7% and then they come back down to 5. We're back kind of where we are right now, right? So it
Yep.
doesn't necessarily mean that they're going to drop below 5, and that wouldn't make sense probably either.
Yeah, and that comes back to that whole timing of the market thing, or trying to time interest rates again, which is a terrible idea. Like get in now, because if rates continue to rise, you're protected. If they come down, you could take advantage of those lower rates if and when they become available. So like never try to time rate, just focus on your payment.
Okay. Do you have any advice for sellers during this market? You know, I think that from my side, I think we're going to see less buyers in the buyer pool, especially because of this happening so quickly, right? It's almost like so fast that the buyers are just starting to figure out that they can't maybe afford that $800,000 house they thought they could afford maybe 2 months ago. Do you have any advice for sellers?
Well, I think for sellers, I think there's ways to get creative, right? If you needed to really draw attention to your listing, I don't think that we're there yet. I think the demand is still there. I think we're still going to see houses moving quickly. But I know at the start of the pandemic, when interest rates did shoot up very, very quickly, one of the things that we were looking at doing is having sellers offer a rate buy down. So basically saying, I'm going to sell my house for 800,000 and I'm offering a $10,000 credit to the buyer to buy down their interest rate. And we could run a comparison and say, okay, if someone's buying a house at 800,000, let's say they're putting 20% down. If they don't buy the rate down, here's the payment. If they buy the rate down by 10 grand, here's what the rate and payment would be. And we could calculate that potential savings, which could be, 40, 50, $60,000 of savings and interest over the life of that 30-year loan. And so it would make that house a little bit more attractive, because a buyer would have a lower payment on that $800,000 house than they would any other $800,000 house. So I think there's definitely ways to get creative. I don't think we're going to see sellers, lining up to offer credits immediately or anytime soon, but I mean, there's definitely ways to, offer those incentives.
Yeah, and there's going to be more room for negotiation versus what we had to do before, which was like, okay, this house is listed at this price. We know the average house is going 3 to 5% over asking. We're going to write that. Plus, we're going to do X, Y, and Z to make the seller happy. Like, we were doing everything in our power to like make it as easy as possible for them to accept our offer. And now maybe
Yes.
have to do as much of that. That not necessarily mean that the seller is going to give you credit, but like there's not going to have to be these like crazy bidding wars like there were before,
Right.
essentially.
Yeah.
Cool. And then, I think so. I just read an article yesterday that mentioned 1994, and that a similar thing kind of happened in 1994. Inflation was crazy high, and they started increasing the mortgage rates to kind of manage it. It was different then because the government didn't really communicate with the public as much or as quickly. Now, like every meeting they come out of, they're like, we're increasing rates, or, every meeting that the banks have, they're saying we need to increase rates. And they're communicating that to the public, and that's kind of like stimulating the market. So, the rates are being increased off speculation.
Yeah.
How much have the rates increased already since the beginning of the pandemic, right? Like from the government side. And then what do you think the speculation is on that too?
Well, I think, again, before the pandemic hit, before the Fed stepped in, rates were pretty much exactly where they are today. They were in the high fours, low fives, and rates got down to the mid twos, right? January of 2021 was the all-time low for interest rates ever, ever, ever. And they've come back up. So I think the markets can be emotional. Now, how much of the emotion in it is there, hard to say. I think we still have things like going on across the world, like in Ukraine, that adds a little bit of uncertainty in the markets. Markets don't love uncertainty. And so there could be some emotional side of it that is impacting where rates are at, that is impacting where the stock market is at. But I think what we're seeing right now is pretty darn normal, right? Interest rates were right where we were before the pandemic started. So I don't think we're seeing rates overinflated, like way higher than what they should be. I think this is pretty normal. This is actually below average. And so I think we still have room for rates to go up before they start to come back down.
Yeah, and the only difference between now and then, just so that everybody is paying attention to this, is that pricing of those homes before the pandemic are different too, right?
Yes.
So
Mm-hmm.
before the pandemic, a new construction house in Fairfield maybe was like, high fours, low fives for a
Yep.
smaller home. Now those same homes are selling for 625 to 700,000. So as these rates go back up, my thought is like, again, people might just not move, and then we still have this inventory issue going forward.
Exactly. Yeah, inventory, I mean, supply and demand, that's like the basic fundamental, right, of economics that controls price. So unless we have a flooded supply of inventory, and we know we still have a strong demand for home ownership, it's going to lead to stable and increasing home prices over time. So we might not see as much activity, right? If there's less homes for sale, right? We might not see that same volume of activity that we're used to, but we're still going to see people purchasing. We're still going to see home prices increasing over time, hopefully at a more normal rate of appreciation, not the 18-20% appreciation that we've been seeing.
Totally. Yeah. And I really just don't think that people are going to move as much. So that will also continue to keep the prices up and moving upward, right?
Mm-hmm.
Very slow, maybe not 20%, maybe 2 to 5% for next year. Maybe this year we'll see the 8 to 10 because we've already seen pricing increase from December to now. It's
Yep.
gone a bit.
Yep.
Cool. All right. Well, I'm gonna open it up to questions really quick. But while we do that, is there anything that you would, any advice you'd give to a buyer right now? Um, from what I'm understanding, you're saying don't wait. Don't
Correct.
market perfectly. It's not going to work for you in your favor.
You're going to get hurt. Yeah. Trying to time the market is like trying to catch a falling knife, right? Like most of the time you're going to hurt yourself, and it's better not to do that, right? Um,
Yeah.
so I think as far as advice for buyers goes is, obviously get pre-approved. If you've been pre-approved before, update your pre-approval to see, because the market has moved with interest rates, have your pre-approval numbers changed. Make sure that you're still comfortable with the payment. Even if you can still qualify for the same amount, that payment might be higher now. So make sure that that's still comfortable for you. So I think just keeping current and having lots of communication with your lender is important. I put out a weekly website called Mortgage Market Guide Weekly, where every single Monday morning, I update it religiously to say for the week before, did rates go up? Did they go down? Did they stay the same? I'll detail out an upcoming report of any economic reports or events that are happening for that upcoming week that could be market movers. So for my clients, I always make sure they've got that info so they can keep an eye on what's happening with interest rates over time as they're out there house hunting. So I think that's super important. I would say don't be discouraged, get fully underwritten up front so that you can put your very best foot forward, right? That you can write, if you love the house and you want to be able to write the strongest offer possible, make sure you've aligned yourself with the lender who will help you write those competitive terms so that your offer can go to the top of the stack, right? Terms are just as important, or pretty darn close as important as to price right now.
Mm-hmm.
The other thing I would recommend, let's see, for our buyers, I think just ask questions. If you have questions, ask questions. Don't be afraid. If you've got questions about fear or the market and it's making you feel hesitant, I would say don't get paralyzed and stick your head on the stand and do nothing. Ask questions to your realtor, to your lender, get the information. Try not to make an emotional decision. I know that's easier said than done. Really look at the facts, look at the rent versus own, look at the forecast for appreciation in the market that you're looking to buy in. We have all of that data for our clients that we provide. Look at what the cost of waiting to buy would be if home prices continue to increase, if rates continue to increase. Again, that's all data that your lender can provide to you. And I think it's very good to have the numbers, because then it helps you from making an emotional decision and making more of a tactical decision. Does this make sense for me?
Yeah, I 100% agree with that, because if you can afford the payment, there's no reason why I hate to say this, you shouldn't be owning or trying to own.
I
At the,
agree.
you know, it's a forced savings account. Even if it's more than rent, it's a forced savings account. And during recessions, typically rents increase. So
Mm-hmm.
really, you're just putting yourselves in again in another situation where you're going to see rents increase, and that's something you can't control. I always try to give that example of
Yep.
Brandon Kim, who took advantage of these low rates and was able to refinance. Like their mortgage is way less than what rents are now. You know,
Oh, absolutely.
so
And
amazing.
and paying rent is like, right? Renting is like having an adjustable mortgage, right? And it only goes one way, it only goes up. Your landlord is never going to call you and say, "Great news, your rent's coming down this year," right? So you gain. A lot of times people think they're scared, right? They don't want to buy because they're scared. They don't know if they can. They don't know what's going to happen in the market. And it's the fear of not wanting to lose money or lose out that kind of keeps people paralyzed sometimes. But I think what people forget, or maybe the question they should be asking themselves, is when do you ever win by renting, right? Like you have 100% chance of losing every single penny you put in rent and getting nothing in return, right? So there's never a time where you win by renting. There's no benefits to you, no tax benefits, no appreciation, no paying down, your mortgage that you're building equity in, all of those things. So it definitely, if you can afford the payment, it makes sense to buy as soon as you're in a position to, as soon as you can.
Yeah. I always joke around, but I saw this on Instagram or something, but it was basically like playing Monopoly, right? You're every time you pass go, you're getting $200. And then
Mm-hmm.
imagine you don't own any properties on the board, like paying rent as you go around the circle, and then you go back again to
Right.
get dollars, and the money just like every single time.
Yeah.
So
Good analogy. I like that.
yeah. Anyways, well, thank you so much, Monica. I really appreciate it. I don't want this to go on for too much longer because I know people are going to get bored of us and our face. And it took a while to start it because like I'm 30 now.
Technical difficulties.
Yeah, we're getting too old for this stuff, right?
We're old millennials.
well, it doesn't help that every time we come on to Facebook Live, there's something new. Like they're like, "Oh, you can't do this now. You have to do it this way." And I'm like, can we set the standard of what this is? Because I barely
Right.
live on TikTok. Okay, like. Awesome. Well, thank you. Thank you so much. And I hope you have a wonderful day. If anybody has questions regarding loans, I hope you'll go to Monica and her team. They are wonderful people who really know what they're doing, and she has really seasoned people on her team that are incredible. And then, with me, if you ever have any questions regarding selling or buying, I'd love to help you, especially sellers right now. I really want you to pay attention to these interest rates and what your buyer pool is doing currently. This was kind of an extreme change that happened between January and now. So we're really seeing some changes. Thank you so much.
Thanks, guys.
All right. Bye.